there, it's David Barnett once again, and this week the question that I received was, is it normal when you buy a business for the vendor to finance 20% of the purchase price? Now, I've done other videos about vendor financing or vendor take-back notes, and this is the first time I've had a question about the normal level of financing that we might expect for a seller to do. The reality is that the amount of financing that a seller has to do relates to two things. Number one, how quickly does the seller want to move the business? The biggest impediment to selling a business is the access to financing. So when I was a business broker and I had sellers that wanted to sell a business very quickly, I would advise them that if they were willing to hold more paper on the deal or do a bigger vendor take-back, then we would likely be able to sell the business faster. The second consideration involved is how many and what kind of tangible goods are included in this business sale. The amount of tangible goods included in the business is going to determine what kind of traditional or institutional bank financing are we going to be able to obtain. So if there are hard assets in the business, such as equipment, machinery, vehicles, etc., then we're going to be able to bring a traditional bank lender in. That means we can get more traditional financing. We don't have to ask the vendor for as much vendor financing. Now, in the question, it mentions 20%. In my experience, I've seen across the spectrum, I've seen equipment-intensive businesses where the buyer had lots of money, the buyer was able to get bank financing, and basically asked for 10 to 15% vendor financing just to give them a little bit of security and to give them all the positive advantages that I've talked about in other videos about why you need to do a vendor take-back when you're buying a business. In other cases, I've had service-oriented businesses without a lot of equipment and material, and they've sold with, I had one that sold with 75% vendor financing. So quite literally, the buyer put in 25% and the seller financed the balance. There was even a period of time back after the financial crisis of 2009 where we did several deals in my business brokerage office without any banks involved at all. They were entirely deals done between buyers and sellers, where the buyer would put down money either from savings or perhaps from a personal debt tool like a line of credit, for example. They would put down their money and the vendor would finance the balance. And most of those deals, it was between 40 and 60% vendor financing. So there's no hard and fast rule when it comes to the amount of vendor financing that you might expect in a deal. Basically, it's completely up to negotiation. And it's important when you're buying a business that you ask for the world. I mean, they're just going to say no. That's fine. That's a part of negotiating. And from the seller's point of view, offering a greater amount of vendor financing can help sell the business more quickly, but more importantly, it can help you actually sell it for a value closer to its true value. Because the difficulty, of course, is always getting financing for that goodwill component. And no bank is going to finance 100% of the equipment, for example. So the buyer needs to have some equity to offset what the bank is going to give him. And in order for a seller to enjoy that last little bit of value, to bring the price of the transaction up to where it should be if it's a profitable business, the seller has to be there to finance it. There's just no other place to get the cash. And I've often had sellers tell me that they didn't want to finance a buyer when they sold their business. And I advised them that, quite frankly, what would happen is because they weren't willing to finance, buyers wouldn't be able to put a deal together. The business would sit on the market for years and years, and eventually the seller would start to lower the price to the point where they would end up with the same cash on closing as they would have if they had sold years earlier and been willing to accept some amount of vendor financing. So it's really a win-win tool for both. It can help secure the buyer's position. It can help offset some of the risk by transferring it from the buyer to the seller. I've explained that in other videos. And really, buyers should be asking for as much vendor financing as they can get, and sellers should be using vendor financing as a way to get the price that they're after. Anyway, I hope that answers the question. And don't forget, if you enjoy my videos and you like what I have to say, please share and like the videos. That's how I grow my viewership. And to make sure that you always get the latest stuff that I put out, be sure to put yourself on my email list. I send out an email every week. Hey, you made it to the end of the video. That's great. Don't forget, visit www.investlocalbook.com. Sign up for my email list. It's right down here under the welcome video. Thanks, and we'll see you next time.